If your agency's tax bill feels way higher than profit showing on your P&L, there's a very good chance your financials are lying to you. And one of the biggest reasons is how agencies handle accrual versus cash accounting. Hi, I'm Craig Cody, I'm a CPA, and we help marketing and PR agency owners improve their cash flow, reduce taxes, and keep more of what they make. Today, I want to walk you through one of the most overlooked financial issues we see in agencies. Why monthly accrual to cash conversions are critical for accurate tax planning, better cash flow forecasting, and smarter business decisions. Point number one, your accrual P&L is not your taxable income. Most agency owners rely heavily on their accrual basis profit and loss statement. And operationally, that makes sense. Accrual accounting is important because it helps agencies track AGI, project profitability, utilization, team performance, and operational margins. But here's the problem. Your accrual P&L is not necessarily showing your taxable income. For tax purposes, many agencies either file on a cash basis or convert their books from accrual to cash at year end, and that timing difference can create huge surprises. Here's a common example. Let's say your agency ends December with $400,000 in accounts receivable. Strong year-end profits, but a large amount of that cash was still uncollected. On your accrual P&L, that revenue already showed up in year one, but the actual cash gets collected in January and February of year two. Now, for tax purposes on a cash basis, that collection may become taxable income in year two. But here's the dangerous part. That income does not show up on the year two accrual profit and loss statement because the revenue was already recognized last year. So the agency owner looks at their numbers and says, why is my tax bill so high? My P&L doesn't even show this income. And that tax disconnect happens because taxable income and accrual accounting income are no longer aligned. Point two, this creates a major cash flow problem for agencies. This is where agencies start making expensive decisions because they're relying on the wrong numbers. They underestimate quarterly taxes, they may hire too quickly, they may take distributions too aggressively, or think profitability is shrinking when it's really just a timing issue. And agencies are especially vulnerable because of how money flows through the business. You have retainers, prepaid media, production deposits, large receivables, pass-through vendor costs, and deferred revenue. All of those things can distort your financial picture if you're only looking at accrual reports. For example, an agency may collect a large upfront payment for media or production work. The cash hits the bank account. The owner feels cash rich, but a large portion of that money may already belong to vendors or future obligations. Without proper accrual to cash reporting, agency owners often spend money that was never truly available in the first place. Quick question. Have you ever had a tax bill that felt completely disconnected from your profit and loss statement? Drop a comment below and let me know what caused the disconnect. Point three, most accounting software gets this wrong. Now here's another huge issue that almost nobody talks about. Most accounting software, including QuickBooks, Workmajig, even Xero, does not perform a truly accurate accrual to cash conversion automatically. So when you click that cash basis button inside your accounting software, there's a very good chance the answer you're looking at is still wrong. And that surprises a lot of agency owners because many systems don't properly account for the timing of accounts receivable, prepaid expenses, your deferred revenue, pass-through media costs, credit card timing, payroll accruals, or agency-specific accounting issues. So owners believe they're reviewing cash basis financials when in reality, they're often looking at partially converted reports that still distort taxable income and cash flow. That's why monthly manual review and adjustment is so important. A proper accrual to cash conversion helps account for accounts receivable, accounts payable, deferred revenue, prepaid expenses, payroll timing, vendor obligations, and pass-through costs. Now your tax planning becomes proactive instead of reactive. You stop getting surprised, you stop making decisions based on distorted numbers, and you gain clarity around taxable income, estimated taxes, profitability, and real available cash. Point number four, agencies need two sets of financial thinking. The agencies that scale successfully understand something very important. Operational accounting and tax accounting are not the same thing, but you need both. Your accrual numbers help you run the agency. Your cash conversion helps you understand taxes, cash flow, distributions, and your other financial risk. The agencies that struggle usually only look at one side. And as agencies grow past $1 million in agency gross income, these timing differences become much larger, especially when you have bigger retainers, larger receivable balances, media pass-through revenue, and more complicated project billing cycles. At that point, monthly accrual to cash review is no longer optional. It becomes a critical financial management tool. So here's the bottom line. Your accrual profit and loss tells you how your agency is performing operational, and that's really important. Your accrual to cash conversion tells you what the IRS may actually tax. If you are not reviewing those differences every month, you risk tax surprises, inaccurate cash flow forecasting, overspending, and poor financial decisions. And if you're relying solely on the cash basis button inside your accounting software, you may still be looking at inaccurate numbers. If you want help understanding where your agency's cash is really going, how to improve profitability, how to reduce tax surprises, and how to create better cash flow, schedule a consultation with our team. We work specifically with marketing and PR agencies to help them scale more profitability and keep more of what they make. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got two things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.